Okay, so my name is Han, and I'll be teaching you guys about mortgages. So a home mortgage loan is a loan from the bank, usually for the purchase of a property, where the title or ownership of the property is in the hands of the lender to secure the loan. The bank or the lender will take a small interest rate of the loan amount over a set period of time. Okay, so let me show you an example of a mortgage. Let's say we have a buyer and he finds the perfect house for, let's say, $500,000. The buyer doesn't have $500,000 cash to spend on a house, so he goes to the bank to get a mortgage loan for the purchase. Assuming that he has a steady income and a credit score suitable for the cost of the house, he puts $100,000 as a 20% down payment, and the loan covers the remaining 80%, allowing him to purchase the property for the asking price of $500,000. Rather than the title going to the buyer, when you typically purchase something, it goes to the bank or the lender as a kind of payment security, so they have rights to the property if you happen to decide not to stop paying your mortgage. This is kind of similar to how if you finance a car, the title for the car, the ownership is in the hands of the lender, so you cannot sell the car without paying it off. And if you miss multiple payments, they can just repossess the car. So it's kind of a similar structure to. So there are two different categories for the type of mortgage plan. There's fixed and adjustable rates. For example, 30-year fixed means that you pay a fixed amount with a fixed interest rate, compounded monthly for 30 years, over the course of 30 years. Whereas something like a 5-1 ARM, which stands for adjustable rate mortgage, that means you have a steady rate for 5 years, and on that 6th year, the interest rate will either go up or down. So the higher the interest rate means that the plan is kind of a bigger risk to the lender or the bank. And the less you pay monthly, the more you pay in interest. So as if you do a 30-year plan, you are paying small payments over the course of 30 years. And because you're paying such a low payment, it has a higher interest rate because there's more risk for the bank. For example, let's say this buyer decides on a 15-year fixed mortgage plan, and 15 years is also 180 months. So he decides on this 15-year fixed mortgage plan to pay off the remaining balance of the $400,000 that he was loaned. So let's assume that his monthly payments are $2,000. As the graphic shows, even though he is paying $2,000 monthly, the first month only about, let's say, $100 goes to actually paying off the loan, and a majority of it goes to paying the interest. And then as it goes on, the amount of the monthly payments that goes towards the interest increasingly gets lower and lower, and vice versa, paying off the loan. So yeah, after a month, even though he did pay technically $2,000, he only knocked off $100 off of the remaining balance because the majority of that goes to the interest. So a jumbo mortgage is a mortgage loan that exceeds $625,000. Jumbo to the high value of the loan. An FHA loan is a mortgage insured by the Federal Housing Administration. Borrowers with FHA loans pay for mortgage insurance, which protects the lender from a loss if the borrower defaults on the loan, which means the missed payments are removed. So, in 2003, a study of discrimination in home mortgage lending, the Association of Community Organizations for Reform Now, abbreviated ACORN, discovered that Seattle African American loan applicants were 2.56 times more likely to be denied a conventional mortgage loan than white applicants in 2002. And a national study by the Center for Responsible Lending indicated in a 2005 study of data released by lenders themselves showed that people of color were more likely to pay high rates for mortgage loans. So gentrification is also an issue with mortgages. Imagine a house which is kind of right on the border between a middle class neighborhood and an upper class neighborhood. If we imagine it's a middle class home, the price of it has only been inflated by the middle class income tax bracket, so like 20%, let's say. But if we imagine it is in like the upper class neighborhood, the price should be inflated by more like 35%. So in other words, it's underpriced from the perspective of the richer neighborhood, and so they'll have an easier time affording it. And the overall effect is that it's easier for someone from the richer neighborhood to snatch up that house because they have probably better credit and income, and so it's easier for them to get kind of a mortgage on that house. And that kind of expands their upper class neighborhood. So now that you have some background on what mortgages are, how they work, we'll have a short Socratic discussion. Came up with a few questions to kind of guide it. Yeah.
I can answer the first one.
You want me to answer?
Sorry, how we? Where we answer?
Yeah.
Gentrification really allows the upper class who have good credit and a lot of money they can afford the houses in the cheaper neighborhoods, and then once they can easily afford and probably fix up the cheaper houses, it becomes a upper class kind of residence and takes it off the lower class market, middle class market.
That's really interesting. Like you were saying about the property being undervalued compared to a different neighborhood, and so if you can swoop in and buy something in an undervalued neighborhood, and be a part, and then the neighborhood transforms, you get to and then sell. You get to take home that appreciation and profit from it. I hadn't really thought about it.
And remember that while you're paying for that house that was undervalued in the neighborhood, all the money that he's paying on interest, which is the first month, right, that gets deduced from your taxes. Right? So not only are you making the benefit of that snatching up the house and the added value, but you're also reducing your taxes in the process.
Yeah, so that kind of answers one of some of the advantages of having a mortgage. As you said, tax deductions. Yeah, that's one of the big advantages.
For the second question, do you think it is better to rent or mortgage a home in a gentrified area? Why? Is it like the areas are gentrified or is it becoming gentrified?
I guess either. either. Yeah.
I think if it's becoming, I think you should mortgage, just so you can own the house, so that when it gets gentrified, the price goes up. But if you're just trying that, you get like the sheets of money, keep it out of the house.
I think that the rent or buy is a complicated question. Like, it really depends on the numbers.
Yeah.
But looking at, so look at the graph, the month to month. You have like the first month, second month, final month. I think one of the things people have to think about, is in that first month, like the idea is if you're buying your house, even on a mortgage, you're not wasting your money on rent, right?
Yeah.
But look how much your money is just going to interest. So it's going to the bank instead of the landlord. And so if your rent, if your mortgage ends up being a lot more than what your rent would have been, it's probably not worth it. But sometimes the mortgage actually is less than what your rent would have been. So.
But I feel like if you're renting, you're not getting anything out of it, you know?
Well, I mean,
You're giving all this money, but then you're just leaving.
But if my rent's only $1,000 a month,
I guess.
what I'm getting is the extra $1,000 a month that I'm not paying for housing.
but if it's a gentrified area, we'll assume it's already, the rent is probably market value. The area, if it's already being gentrified, so it's assuming it's kind of a nicer apartment, right? So it's gonna be a high rent. So then, if you want to, if you're gonna get a mortgage, yeah, it really just depends on how much the mortgage is and the value of the property. Because if you're gonna start renting, and it's gonna start being like $3,500 a month, then like it probably could be cheaper. It matters like long term, how long you're gonna stay there. Because if you plan on staying there for the next 50 years, then you'll have that rent control in 50 years, and then technically the amount of rent you pay that apartment should probably be cheaper than a mortgage. But it's all a lot of.
Yeah, there's a lot of variables that go into like whether it would be better to rent or mortgage a home, like how long you're staying there, or like how long your mortgage thing is. There's ways to like kind of calculate the better option.
Yeah, so I have friends who, interesting, so friends of friends, I don't know those people, but my friends know them well. Moved to San Francisco maybe 15 years ago when the Presidio was just coming on the market for rental. At the time, they were living up in Pack Heights, or they had a house in Pack Heights. But the house was a big house. I mean, those are people who make a lot of money. But it was interesting in their mind. So they had the house. Apparently there was fire damage from the house nearby. So then they were faced with we have to like rehab the house, right, and stay here. And then they suddenly realized that if they actually lived in the Presidio, in one of those like big general houses, even though the rent is super high, it was so much lower than the price than the cost, what it would have cost them to mortgage and eventually own the house in Pack Heights. And to this day, they live in one of the general houses in Presidio because even though their rent is probably $10,000 whatever per month, it's still orders of magnitudes smaller than what they would pay property taxes on a large house in Pack Heights. So it was, it was interesting as a calculation, Of course, the people who do that are people who can afford that, make this kind of package.
One thing you hear a lot about, which you didn't mention, was people being underwater in their mortgages. Did you come across what that means?
No, underwater.
Yes, anybody heard that? Being underwater on your mortgage?
I've heard of it.
What's that?
I've heard of it, sure.
So if you go back a couple slides, back, one more. That little stuff there. So he's paying $500,000 for this house, right?
Yeah.
What happens? And so after a few months, he owns $498,000. What happens if there's a housing crash, and suddenly he has to sell the house, but now he can only get $350,000 for it? To sell the house, he has to pay off the bank. And he owes the bank how much?
They can sell the house and use
More
the
than the
rest.
house is worth. They're just gonna be in debt to the bank.
That's right.
They can use the money he earned, the 250 he earned from selling it, or the 350 he earned from the house to pay off 2 weeks the mortgage.
But the mortgage is 400,000.
I thought you said the mortgage, he already paid off 498,000.
No, he still owes 400, or he
So he only put down $2,000?
No. I should have said, okay, he owes 398,000. He's only paid off $2,000. It's been 2 months.
And he put 100,000 down.
He put 100,000 down. So he owes the bank more than the house is worth.
I mean, the chance of the market dropping so like.
This is what happened in the housing crisis.
Right? Say
Yeah.
you buy a house in Tracy, right? There was like enormous tract houses that were built in Tracy, anticipating lots of people wanting to commute to San Francisco, right? Or out by Livermore or whatever, like in that area. And then all of a sudden, housing bubble, nobody wants to live there. And now people are stuck with half of their houses and mortgages for a house in Tracy that nobody wants to buy. You are now officially underwater. Now the questions are, do you pay back the entirety of the loan, which is going to cost you more than the rest of the house, and sort of hoping to play the long game, and maybe the market will rebound, or do you just abandon the house?
But lots of houses their value fell by 50%. And so then people couldn't move. Or then if they were in a situation where they couldn't pay the mortgage, the bank repossesses it to try to recoup the money, and you still owe the bank more money because the bank, whatever you weren't able to recoup, you still owe. And the other place where that happens is the different kinds of loans, the ARM loans, adjustable rate mortgages. So notice that the adjustable rate mortgages, say those are 30 years, the interest rate's better, right?
What are those?
But the interest rate is,
It's better at the beginning for 5 years. So people are, and people were being encouraged to take on as big a loans as they could. They're paying 3.6% for 5 years, or for 7 years, and then after that, the bank gets to set the mortgage rate again. It's not anything, but it's based on prime rates and stuff. But if interest rates have gone through the roof in that time, suddenly your interest rate goes up to 10%. What happens to your payment? Your payment goes up by hundreds of dollars or $1,000, and what if you can't pay it? You even if you're not underwater, you can't pay it. The bank says, well, we're going to take your house, we're going to foreclose, and
That is one of the things that happened to African American and general people of color during the last housing boom, is that people were pushed to take on those adjustable loans, right? That they barely could afford to start with the interest rates going way up after a couple of years. And again, like you talked about discrimination for getting loans, right? Who's talked about redlining at some point?
Yeah.
Was that
Red
redlining?
Oh,
it's always.
So that's one form of, so mortgage denial was one form of redlining. The other one was people were given a loan instead of being given a low rate loan, they were given those variable mortgages, which ended up killing them. And what people would do is they would be given a loan to live in an area that isn't that great. The loan would be variable. After a couple of years, they would get, the rate would go up, they wouldn't be able to afford, they'd get repossessed, and then the house goes back in the market to get, somebody else gets the loan of the house. And you get this cycle of houses that are just turning, that are there just to literally like milk money out of population of color, which was fairly well documented. Yeah.
Can the banks just raise the price whenever they feel like it? Or is there like regulations and things that they have to follow?
Yeah, there's
Like interest rate?
yeah, there's regulation of interest rates. There's like the federal government sets like a base rate that is the amount that banks charge each other for loans. But part of your terms of your contract would be, well, we're going to charge you this much more than what the prime rate is. Yeah. But then, so with the housing crisis, the big thing that happened though was that the banks had given so many loans to so many people who could barely pay them, that when things went south, so many people were unable to pay, and they were having to foreclose on so many houses that they were losing, the banks were losing money, and the banks were going out of business. And then they said, well, the whole economy will collapse unless you bail us out.
Which we did.
So I know, like you mentioned that, like credit score and like, I guess like income like matter, in factoring into like how much you pay for mortgage. But like, I was wondering like how much, like, does the credit score matter more than the income or like vice versa?
Yeah, I'm not quite sure about that. I'm sure that the credit score is probably important because they want to know that you'll make your payments on time and stuff. But yeah, I think they're both like almost equally important because yeah, they need to make sure that you can have a problem and have good credit and stuff. But yeah, I'm not quite sure.
Yeah, it's kind of both and. Like they have to see that you haven't that your income is sufficient. Like if it's not sufficient, they're not going to give you the loan, and that you have a history of actually paying back loans. So you might have enough money, but like you never pay back. You've never paid your debts in the past. So they're like, we don't trust you. Too bad.
So let's say you have pretty like, poor credit and they do decide to give you a mortgage or a loan. The bank, what do they, when you have like a lower credit, do they raise their interest more? Or is that what it, so then since you can't pay back the money, they're going to end up charging you more? Kind of, like, doesn't really.
Right, so this is interesting, right? This happens for a number of cases. This happens in private schools, right? It's, if you cannot pay the full tuition, disregarding the amount of like financial aid, but like let's say you can't pay the full tuition in one big payment, then there's a fee, there's a finance fee that is imposed on people to pay like in monthly installments, for example. So it's interesting that it's the people who can't pay the full tuition who then get
Higher interest.
would get charged an extra fee for doing things. That being said, there's the people who are fronting the money, whatever. I mean, there's a sense that I don't know. So that's one thing to think about. But yes, if you are Donald Trump, right? No, I'm just Donald Trump. But like, if you have a lot of money and you apply for a mortgage, right? You will get a better rate than if Joe Schmo asks for a mortgage. Absolutely.
Does
So
that
not
make
only can you afford to pay, not only can you deduct your taxes, but you get a better rate. I mean, it's just like.
Just because it's less risk over the bank.
Right, does that make sense from the bank's perspective? Imagine you're a bank loaning somebody money. You're like, I don't know whether I'm going to loan 10 people money. I only think 5 of them are going to pay me back.
Donald Trump here has $2 billion.
Right, you're going to want to charge the people who you don't think are going to pay you back more, so that on the average you will make your money back. If you're certain they're going to pay you back, you don't need to charge as much to come out ahead.
Does anybody want to guess what percent of homeowners in the U.S. are being mortgage free?
8, 15.
Small.
Higher than
Very
22.
low.
22. Yeah, it's about 1/3 living mortgage free, and about 40% are renting, 60% are homeowners, and And of that 60%, 1/3 are living mortgage free.
So a third of the mortgage people are mortgage free. Of the owner homeowners
Yeah.
are. So that's interesting, right? So that's nationally?
Oh, that's in the US.
In the US, right? So nationally in the US, 60% of the people own their home. In San Francisco, it's less than 25, right?
Remember?
I think it's 75% of the people in San Francisco rent. Just